Bank runs are truly fascinating, not just from an economic perspective but from a psychological one as well. A bank run can even turn a seemingly healthy institution into an insolvent bank. Pretty much all banks would become insolvent during a bank run if, let's say, 1 out of 3 depositors demands physical currency. Let's take a close look at bank runs and see how banks can become insolvent and fail if a perfect storm bank run situation arises. Only a fraction of the current scene existence is actually tangible, so paper money and coins. Wow, I didn't know the debt banks create by giving loans is actually money nowadays. Back in my day, most of the money we used was tangible. Let's assume that bank, like any other bank, has customers who trust it with their money for various reasons. Some create bank deposits, some simply keeps them spending money in their bank accounts, and so on. These people are legally allowed to go to the bank and take their currency out in the form of paper money. The problem is that most of the currency banks manage doesn't exist physically.
For the sake of our discussion, we will assume 10 of the currency bank manages is tangible, and we will also assume it actually keeps that paper money involved. If too many people request physical currency, we'll run out of paper money. If 2 out of 100 customers ask for physical money, the bank can handle it. But it just doesn't have that much physical currency. To make matters worse, the depositors would panic and spread the word, causing a bank run, which is kind of like an infection. As more people find out a bank is in trouble, they tell others, and this might make depositors stop trusting banks in general.
Welcome to our presentation. Today, we will present the topic, why are bank failures considered to have a greater effect on the economy than other types of business failures? Do you agree with this conclusion? The first aspect we want to mention is functions of banks. Thrift or saving function, taking the surplus funds as deposits from individuals and institutions. Credit function, providing principal source of credit for households, for most local units of government and for businesses. Payments function, carrying out payments for goods and services on behalf of their customers. Cash management function, handle cash collections and disbursements for a business firm and to invest any temporary cash surpluses in interest-bearing assets until cash is needed to pay bills. Insurance function, selling insurance and providing financial advice to their customers. Brokerage function, offering their customers the opportunity to buy individual stocks, bonds, and other securities without having to go to a security dealer. The guarantor function, standing behind their customers to pay off customer debts when those customers are unable to pay. Investment banking, identifying possible merger targets, financing acquisitions of other companies, dealing in a customer's securities. Now we will clarify more about why are the bank failures considered to have a greater effect on the economy than other types of business failures. First, we need to know what is bank failure. A bank failure occurs when a regulator closes an insolvent bank. An insolvent bank can't meet its obligations to depositors, e.g., it doesn't have the money to meet withdrawal demands, or to creditors, it can't pay its debts.
Why are the bank failures considered to have a greater effect on the economy than other types of business failures? 1. No lending. 2. Lowering demand. 3. Consumer confidence dips. 4. Demand, deficient unemployment. No lending. Plus, the present rule of thumb is that the lower your credit score, the less likely your bank is willing to give you a loan. You can say goodbye to any personal loans or business loans when there is a bank failure. Plus, the consequence of not receiving a business loan for a firm is quite drastic. Without a loan, a firm will employ fewer people so they can afford to financially support all their employees, thereby leading to more unemployed individuals. Product development might slow down without business loans to purchase machines, appropriate manufacturing hardware, and storage units. Lowering demand. Plus, without banks giving out any personal loans, business loans, and financial assistance to their borrowers, the amount of money put into investment diminishes and the financial market underperforms. Plus, lowering demand leads to industries requiring fewer investment to fuel the production of their goods and services. Hence, a reduction in lending leads to lower investment required in the long run. Consumer confidence dips. Plus, with low employment rates, no lending available from banks, and slower turnover rates for products and markets, investor sentiments become more risk-averse. This is the direct result of losing confidence in economic growth. Consumers will favor putting their money into savings deposits as opposed to reckless spending. Plus, this creates low demand, as consumers' sentiments will be geared more to protecting their own wealth as opposed to living a comfortable lifestyle. Consumers will also probably become wary of the bank, which is undergoing a crisis. They will avoid using any of its services as a means for depositing their money and keep their cash in liquid form in physical safes. Demand deficient unemployment. Plus, bank failure causes two types of unemployment. The outcome of all this is the second type of unemployment, demand deficient unemployment. Plus, in the first case, demand may still exist but the company does not have capital from the bank to afford extra employees. In the second case, there is no demand and, hence, sales are low and money spent on production is wasted. To cut costs that the company is not able to make up for via sales, it drops its employee count and stops hiring new people. In conclusion, bank failure has a significant triple effect on a nation's economy.
3. Besides, the failure of some other business also affects the economy. Firstly, finance companies are financial institutions that specialize in providing short and medium-term credit to customers and small businesses. The roles of a finance company are consumer loans, business and financial leasing, and loans to real estate. When financial companies go bankrupt, we will lose a source of financial loans to be able to invest and develop the economy. The second is business services. It is a popular type of business today, including many fields such as tourism, restaurants, hotels, information technology, and plays an important role in the development of the economy, such as promoting economic development in the direction of modernization, creating links between manufacturing industries, creating many jobs, and bringing in a great source of income for the economy. If the service business fails, the economy will lose a large source of revenue from the domestic currency to the foreign currency. The financial condition of the people will face many difficulties, the country's economy will be slow to develop. Next, manufacturing businesses also play a rather important role in the economy. It helps to make products for use, or for exchange in internal and external trade to bring high economic benefits. The sustainable development of manufacturing enterprises proves an autonomous and stable economy and seed jobs for workers. When the manufacturing enterprises go bankrupt, the country will lose a large supply of products to serve consumption and export and lose many large sources of revenue from production business, lead to the economic slowdown. However, the development of the above business types depends largely on loans from banks. When the bank fails, it will make it difficult to finance investment and development of businesses from there, making the economy shaken, making it difficult to sustain and sustainably develop in the long run. Therefore, the collapse of the bank will have a greater impact on the economy than the collapse of other types of business. Thanks for watching.